Welcome back. Today's episode is one I've wanted to make for a long time because it lives at the intersection of behavioral psychology, consumer economics, and one of the most persistently misunderstood concepts in personal finance, the difference between appearing wealthy and actually being wealthy. These are not the same thing. In fact, the research suggests they are frequently in direct conflict with each other, that many of the behaviors and purchases most associated with looking wealthy are precisely the behaviors most likely to prevent actual wealth accumulation. And yet, the performance of wealth has never been more prevalent, more visible, or more culturally rewarded than it is in the era of social media. Now, and I want to say this clearly at the start, the purpose of this episode is not to judge anyone, and it's definitely not to mock people for their spending choices. Every person has their own financial situation, their own values, and their own relationship with money. What this episode is about is something far more useful, helping you recognize patterns in other people and potentially in yourself that are correlated with financial performance rather than financial substance, because recognizing those patterns can save you an enormous amount of money and protect you from some serious financial mistakes. The research on this topic is genuinely fascinating. Let's get into it. Thomas J. Stanley and William D. Danko's landmark research published in The Millionaire Next Door, 1996, updated by Stanley's subsequent work in Stop Acting Rich, 2009, found that the majority of American millionaires live in modest homes, drive used or modestly priced cars, and avoid conspicuous consumption. Their research found that the people most likely to own expensive luxury goods and display outward signs of wealth were typically not millionaires. They were high-income earners with low net worth who were spending the majority of their income on status signaling rather than wealth accumulation. Stanley coined the term big hat, no cattle to describe this pattern. The 10 signs, what the research actually shows. Sign number 1. They talk about money constantly, but never about wealth. This is one of the most telling behavioral signals, and it's rooted in what psychologists call compensatory signaling, the tendency to broadcast information about areas where we feel insecure. Genuinely wealthy people, as a rule, don't talk much about money. They talk about their work, their interests, their values, their relationships. Money is a background fact of their life, not a conversational centerpiece. By contrast, people who are performing wealth often reference their income, their spending, their purchases, and their financial status frequently, and in context where it doesn't naturally belong. The psychological driver is the same as for any compensatory behavior. The more anxious someone is about a status they're trying to project, the more effort they put into projecting it. Genuine security in any domain typically doesn't require vocal reinforcement. Research by psychologist Paul Piff at UC Berkeley found that lower-income individuals were more likely to conspicuously display wealth signals and talk about money in social settings than higher-income individuals of comparable social groups. The researchers attributed this to what they called status anxiety signaling, a documented behavioral response to perceived status uncertainty. Confirmed high-status individuals show lower rates of status signaling behavior, precisely because their status is not uncertain. Sign number 2. They drive a car that's worth more than their annual savings. Cars are the single most common vehicle, no pun intended, for wealth performance. They are visible, mobile status symbols that can be accessed through financing at relatively low monthly cost, creating the appearance of substantial wealth at the actual cost of a car payment. The auto industry has mastered the art of making a $75,000 vehicle feel accessible at $1,100 per month. The research on actual wealthy households tells a different story. The most common car driven by American millionaires is consistently found to be a Toyota, Honda, or mid-range domestic brand, functional, reliable, reasonably priced. Not because wealthy people can't afford more, but because genuinely wealthy people tend to have strong anti-waste instincts and see depreciation-heavy luxury vehicles as exactly what they are: very expensive, rapidly depreciating consumption items that produce no financial return. Thomas Stanley's research in Stop Acting Rich, 2009, based on surveys of thousands of millionaires, found that the most popular car brands among American millionaires were Toyota and Honda, followed by Ford. Less than 25% of millionaires surveyed owned a luxury vehicle at the time of survey. The average price paid for a vehicle by millionaires in the study was approximately $31,000, significantly lower than the cultural association between wealth and high-end automobiles. Meanwhile, Stanley found that the owners of the most expensive vehicles were disproportionately drawn from high-income, low-net-worth households. The car-to-savings ratio is genuinely useful as a mental heuristic. A person who earns $80,000 a year and drives a $65,000 financed vehicle while holding $4,000 in savings is not wealthy. They are consuming future wealth to perform current wealth. The two look the same from the outside. They produce very different financial trajectories over a decade. Sign number 3. Their lifestyle inflates in lockstep with every income increase. One of the most reliable behavioral signatures of genuine wealth builders is that income increases do not automatically produce proportional lifestyle increases. They save or invest a meaningful portion of every raise before the lifestyle adjusts to the new income. The result is a widening gap between income and spending, which is where wealth comes from. The person performing wealth does the opposite. Every raise brings a newer car, a nicer apartment, upgraded wardrobe, more frequent travel. The spending rises to meet the income almost immediately, closing the gap before it can compound into savings. This is what economists call Duesenberry's relative income hypothesis, and behavioral economists have studied extensively as lifestyle inflation, and it is one of the most effective destroyers of long-term wealth accumulation available. Research by economists Duesenberry and later confirmed in behavioral economics literature by Frank, Levine, and Dyke found that consumption expenditures are heavily influenced by reference groups, the spending norms of peers, colleagues, and social media contacts. As income rises, people upgrade to higher reference groups whose consumption norms are higher, producing expenditure increases that track income increases remarkably closely. The researchers found that only deliberate, pre-committed savings automation consistently broke this pattern because it captured income increases before the lifestyle reference group adjustment could occur. Sign number 4. They lease everything and own nothing. Leasing is a financially rational decision in specific circumstances, when you genuinely drive high mileage, when cash flow management is a priority, when business use makes the deduction valuable. But leasing as a default strategy for accessing things that appear luxurious without the capital required to own them outright is one of the most common financial patterns of wealth performance. The appeal is obvious. For a monthly payment, you can drive a $60,000 vehicle that you could not afford to purchase, but the financial math over time is brutal. You own no equity. The vehicle returns to the dealer. You lease again. You spend continuously on something you never build ownership in. This is consumption masquerading as an asset, and genuinely wealthy people understand the distinction clearly. The Federal Reserve's Survey of Consumer Finances consistently finds that leased vehicle prevalence is higher among households in the top income quintile, but middle wealth quintile, confirming that leasing is most common among high earners with lower net worth relative to income. Households with high net worth relative to income show significantly higher rates of outright vehicle ownership and longer average vehicle holding periods, consistent with the wealth-building pattern of reducing consumption of depreciating assets. Sign number 5. They carry visible designer logos everywhere. This is a nuanced one because plenty of genuinely wealthy people own and wear luxury goods. The signal is not the luxury goods themselves, it's the role they play. For genuinely wealthy people, luxury goods are one consumption category among many, bought for personal enjoyment and quality rather than for external validation. The wealth performance version is different in character. The logo is the point. The brand name is prominently displayed. The purchase is made at financial strain that most observers wouldn't suspect, funded through credit, payment plans, or at the expense of savings and investment. The research on conspicuous consumption confirms that logo-forward luxury spending is disproportionately concentrated among people who are financially insecure about their status relative to their reference group, not among those whose status is already firmly established. Psychologists Han, Nunez, and Drez published influential research in the Journal of Marketing demonstrating that conspicuous display of loud, visible luxury brand logos was most prevalent among parvenus, people newly arrived at higher income levels who were anxious about their status recognition, and least prevalent among patricians, the genuinely wealthy who felt no need for external status validation. The researchers found that the most expensive luxury goods were typically the quietest in branding, purchased by genuinely wealthy consumers who preferred subtle quality signals. The loudest logos were concentrated at lower price points purchased by status-anxious consumers. Sign number 6. They don't talk about or seem to know much about investing. Genuinely wealthy people almost universally have a working knowledge of how their money is invested. They know the rough composition of their portfolio. They understand what a stock or bond is. They have views on asset allocation. Wealth is not primarily built by earning more. It's built by deploying what you earn into assets that appreciate. People who are actually building wealth spend some portion of their attention on the investment side of their finances. The person performing wealth typically has remarkably little knowledge of or interest in investing. Their financial attention is almost entirely on the consumption side, on what to buy, where to vacation, how to spend. The question of how to grow the money is secondary or absent. This isn't a judgment about intelligence. It's a behavioral pattern that reflects what the person actually values, the appearance of wealth, not the accumulation of it. Anna Maria Lusardi and Olivia Mitchell's foundational financial literacy research, published in the American Economic Review, found that individuals with higher financial literacy accumulated significantly more wealth by retirement than comparable peers, not because they earned more, but because they made better investment and savings decisions. The researchers found that financial literacy differences accounted for 30 to 40% of the wealth gap between high and low wealth households. Conversely, households focused primarily on consumption without investment knowledge consistently showed lower wealth accumulation than income levels would predict. Sign number 7. Their social media is a curated highlight reel of spending. Social media has created a genuinely new category of wealth performance, the digital lifestyle broadcast. Private jets, first-class lounges, luxury hotel rooms, designer purchases, fine dining, displayed consistently, aspirationally, and in a way specifically engineered to signal wealth to followers. The research on this behavior is fascinating because it reveals the psychological mechanisms driving it with unusual clarity. The key insight from platform behavior research is that people post what they want others to believe about them, not necessarily what reflects their actual lived financial reality. The person posting a private jet photo may have purchased a one-time flight share through a fractional jet service for $800. The luxury hotel photo may be a one annual vacation splurge from someone who otherwise lives paycheck to paycheck. The curated financial highlight reel is specifically designed to produce an impression, and it does, even when the underlying reality bears no resemblance to it. Research by Vogel and Rose, published in the Journal of Social and Clinical Psychology, found that exposure to upward social comparisons on social media, viewing content from people with apparently higher status or wealth, was associated with increased materialism, decreased life satisfaction, and increased spending on status goods among viewers. The researchers concluded that social media creates a reference group of curated aspirational wealth that is systematically unrealistic, producing spending behavior driven by comparison to a fictional norm. A 2023 survey by LendingTree found that 39% of Americans had gone into debt specifically to keep up with social media-driven spending expectations, a direct measure of social media's power to generate financial harm through wealth performance imitation. Sign number 8. They always have the latest tech immediately. Here's a specific, observable behavioral pattern: immediately upgrading to the newest smartphone, laptop, or gadget release, regardless of whether the existing device needs replacement. This pattern is notable for several reasons. The absolute cost is meaningful. Annual smartphone upgrades cost $800 to $1,400 per cycle. The opportunity cost is significant, and the behavior is a textbook expression of conspicuous consumption driven by novelty and status signaling rather than functional need. Genuinely wealthy people are, on average, notably resistant to unnecessary technology upgrades, not because they can't afford them, but because their spending is governed by genuine utility rather than status anxiety. The question they ask is, does this serve me better than what I already have? The status performer asks, does having this signal that I am current, successful, ahead of the curve? Veblen Goods research, named after economist Thorstein Veblen, who first theorized conspicuous consumption in 1899, consistently finds that consumer electronics, particularly premium smartphones, exhibit strong Veblen characteristics. Demand increases with price because the price itself signals status. A 2024 Consumer Reports survey found that 68% of annual smartphone upgraders cited wanting the latest features or model as the primary motivation, while only 32% cited their existing device being inadequate. Among households with high liquid savings relative to income, the upgrade rate was significantly lower, suggesting that financial security reduces the status signaling driver of unnecessary upgrades. Sign number 9. They have no emergency fund and no savings buffer, despite apparent income. This is the sign that cuts through all the visible signals most definitively, but it's also the hardest to observe from the outside. The person performing wealth often has an excellent income and terrible financial resilience. The income goes to the car lease, the rent on an apartment in the right neighborhood, the wardrobe, the restaurants, the vacations, and the emergency fund is either minimal or non-existent. The practical consequence is visible in moments of financial disruption. A job loss that would be a manageable inconvenience for someone with 6 months of savings becomes an immediate crisis for someone who has been consuming every dollar of income. The performance of wealth specifically requires spending the money that actual wealth would require keeping. They are structurally incompatible when the income is not high enough to fund both, which is the case for most people performing wealth. The Federal Reserve's report on the economic well-being of U.S. households consistently finds that a striking proportion of higher-income Americans carry essentially no liquid savings, despite relatively high earnings. In the 2022 report, approximately 22% of adults earning between $50,000 and $100,000 annually reported being unable to cover a $400 emergency from savings alone. This income band represents households that frequently display lifestyle markers of financial success, newer cars, nicer homes, branded goods, while maintaining essentially no financial buffer. The income supports consumption. It does not build resilience. Sign number 10. They avoid or deflect direct questions about money with vague answers. Genuinely wealthy people tend to be either straightforwardly private about their finances, they simply decline to discuss specifics, which is perfectly reasonable, or openly matter-of-fact when the conversation arises. What they rarely do is perform vagueness that implies wealth without confirming specifics. The person pretending to wealth has a different pattern. They drop references to expensive things, high earnings, or financial success in casual conversation, but become evasive or change the subject when questions get specific. I do pretty well when asked about income. Things are good when asked about business. The performance requires the impression of wealth without the accountability of specifics because the specifics wouldn't support the impression. This is behavioral signaling in its most transparent form. All signal, no data. Research on impression management theory by sociologist Irving Goffman, extended into consumer context by scholars including Belk and Solomon, describes a class of behaviors specifically designed to create social impressions without conveying verifiable information. Status ambiguity, deliberately leaving the observer free to assume the most favorable interpretation, is a documented component of aspirational consumption behavior. Studies show it is most prevalent when the gap between one's actual status and desired perceived status is the largest, and least prevalent when actual status is already high enough to stand on its own. At this point, you might be thinking, okay, but why? Why do people consume in ways that perform wealth at the expense of building it? This isn't a judgment. It's actually a very interesting question, and the behavioral psychology behind it is well documented. The short answer is that human beings are deeply social animals whose sense of self-worth is substantially tied to perceived status within their reference group. This is not a character flaw. It's an evolved social instinct that was highly functional for most of human history. Status within a social group determined access to resources, mates, and protection. It mattered enormously. That drive didn't disappear when modern consumer markets arrived. It got redirected toward the signals those markets offer. Robert Cialdini's research on social proof, Veblen's foundational work on conspicuous consumption, and subsequent decades of consumer psychology research all converge on the same finding. Spending on visible, status-conferring goods and experiences is primarily driven by social comparison anxiety, the need to be perceived as equal to or above one's reference group. This drive is stronger when perceived status is uncertain or threatened, stronger among people who lack other secure sources of self-esteem, and stronger in cultures with high inequality that produce larger status gaps. The United States, as one of the most unequal developed economies in the world, creates particularly strong structural conditions for wealth performance behavior. Understanding why the pattern exists is important because it changes how you interpret it, from judgment to compassion, and it changes how you relate to it in yourself, because most of us have some version of this drive. The question is whether we're consciously channeling it or unconsciously being spent by it. The key distinction, buying things you genuinely enjoy and value, even expensive things, is not wealth performance. Buying things primarily because of how they make you look to others at the cost of your actual financial health is. The driver, not the purchase, is the signal. What actual wealth actually looks like? Let me close the substantive section of this episode with something worth knowing. What does actual documented wealth look like in practice? Because it often looks nothing like what the culture says it looks like, and understanding the contrast is the most useful takeaway from this entire episode. In Stanley and Danko's research and in the broader wealth research literature, the behavioral profile of genuinely wealthy people is remarkably consistent. They live in houses that are worth less than 3 times their annual income. They drive cars that are several years old, often bought used. They don't carry credit card balances. They have diversified investments across multiple asset classes. They have strong emergency funds. They know their household cash flow to within a few $100s per month. Their lifestyle looks comfortable but not ostentatious, certainly not like the social media version of wealth. The Millionaire Next Door research found that the average American millionaire in their study lived in a house with a market value under $500,000 in 1996 dollars, had been married to the same spouse for decades, spent less than $200 on their most recent pair of shoes, and had never paid more than $400 for a suit. They accumulated wealth not through dramatic spending restraint, but through a simple, consistent pattern. They earned more than they spent, they invested the difference, and they did this for a very long time. The dramatic difference between this reality and the cultural image of wealth is itself a data point about how effectively wealth performance has colonized the popular imagination. The truly wealthy person isn't necessarily in the room with the most expensive watch or the newest phone or the most logo-forward outfit. More often, they're the one you can't identify from external signals at all because they stopped needing external signals a long time ago. Let me close with the question that I think is the most valuable thing to take from this episode. Not about other people, but about yourself. How much of your current spending is driven by what you genuinely enjoy and value, and how much is driven by the image you want to project to people whose opinion, when you think about it honestly, may not matter as much as the financial cost you're paying to maintain it? That question, asked honestly and revisited regularly, is one of the most powerful financial tools available. Not because the answer is always spend less on appearance. Sometimes spending on how you present yourself is genuinely important to you for genuine reasons, and that's completely valid. But the question itself of driver and value alignment is what separates intentional financial behavior from reactive, comparison-driven consumption. The gap between looking wealthy and being wealthy is not primarily an income gap, it is a behavior gap. And behavior is something you can change, starting with understanding what's driving it. Thanks for watching. Drop in the comments which of these 10 signs do you think is the most common or the most damaging. I read every comment. Share this with someone who'd find the research interesting. Subscribe for the next one. See you there.